Is everyone familiar with what a volume profile is? I imagine most people have a rough idea. It's just another way of visualizing price and volume data, which I think can be really helpful. And as I said last week, for some of you, I think it will really click. And even if you don't want to incorporate what I'm going to be talking about today into your trading decisions, your trading plan, I think this webinar will still be useful in just kind of giving a different perspective on some of the stuff I've already been talking about and just reinforcing those ideas. So I'm just going to start by explaining what a volume profile is, just so that we're all on the same page. So as opposed to volume by time, right down at the bottom here, which you're probably all familiar with, and which price is displayed on the x-axis, and that's of course how much volume was transacted in each bar. Okay. Volume profile just displays volume by price, so on the y-axis on the left here or on the right. So it shows you how much volume transacted at each price or over a series of prices, and just displays this in a histogram. So it's a little bit like the footprint, in that it records exactly how much volume transacted at each price over a specified period of time. But instead of displaying it in bars like this, in this case 5-minute bars, this is a composite profile, and it just displays how much volume was transacted over a series of prices over the period of time which is visible to you here. Okay, so if you've ever tried to read up on volume profile, what you've probably encountered or come across is quite a lot of information on market profile theory, because volume profile is really relatively new. Market profile was the precursor to volume profile, and it's kind of similar, but instead of plotting volume by price, it's based on time. Okay, so we'll talk a little bit about this later on, but I'll just quickly show you that this is a market profile. Okay, so each of these represents a day, and on the left here you've got market profile, and on the right you've got volume profile. And what market profile does is just show you how many times during the course of a session or day, whatever time frame you've got it set on, price traded through a specific price. So in this case, each of these letters here, okay, you'll see it's kind of coded alphabetically. Each of these letters represents a 1-hour candle in this case. So the letter A here at the start of the day, this is the first hourly candle in this day. The letter B is the second hourly candle, and so on, okay, all the way up to X. So it just records and displays how much time price spent trading at a specific price or of a series of prices. Okay, so how much time price spent trading there as opposed to volume. And as you can see, they're quite kind of quite similar, right? In that the more times price traded through a level or at a level, the more volume is likely to have traded there. So the volume profile and market profile tend to kind of align for the most part, unless you've got some anomaly. Now, most of what you'll read when you read up on volume profile or market profile revolves around day types, which come from traditional approaches to market profile. So, for example, you've got what's called a D-Day, which looks something like this, okay, in which price forms basically a kind of normal distribution, right? A D shape, a range or consolidation, in other words. You've got what's called a P-shaped day, a B-shaped day. These are sometimes referred to as short covering or long covering rallies, which I'll explain later, in which the the bulk of the volume is traded at one extreme or the other. Okay, a bit like this day here. Okay, it's a P-shaped profile. And then you've got trend days, which will look a little something like this, in which there are multiple, usually quite kind of short distributions and little overlap in volume. Okay, so those are the main kind of day types you'll read up on when you try and look into volume profile or market profile. But yeah, I really don't want to spend too much time on that, because for me, looking at price in terms of day types and trading them accordingly is just kind of another form of pattern trading. Because regardless of the shape of the profile, it is, as always, the context which is most important. Okay, it's really the liquidity dynamics I'm interested in. So with that being said, what am I looking for in the profile? You're probably aware by now that my whole kind of trading style revolves around identifying areas I expect price to move through with relative ease, and areas in which I expect there to be liquidity and which I therefore expect to stop price or cause it to reverse. And volume profile is a great way of kind of visualizing these areas. So I'm mainly using it for two things. First, to find potential price turning points which may not otherwise be kind of obvious to me. And second, to gauge the market environment. So what kind of market environment is price trading in? By which I really mean, forecast volatility. Okay, do I expect volatility, or do I expect kind of low liquidity range or chop? So in other words, I'll use it to find areas in which or where I expect price to reject, areas I expect price to run through quickly, and areas at which I expect price to get kind of stuck or spend a substantial amount of time trading. So basically areas of balance and imbalance. And I mean, by now, areas of imbalance, so wide ranging, usually illiquid moves will look something like this on the profile. So you can see that price has spent very little time trading down at the bottom of this day, and as a result, there's very little volume traded there. And in contrast, areas of balance or consolidation are obviously going to be characterized by an overall resemblance to a normal distribution, something more like this or this day here, in which the volume is usually kind of greater in the middle of the range, in the middle of the day, and would kind of taper off towards the highs and lows. All basic stuff so far. So let's see if I can get an example on the composite profile. Okay, these are nice examples. So when price is consolidating like it is here, or like it is down here, on whatever time frame, there's relative stability or equilibrium. Okay, equilibrium on this time frame, in this case the daily. So we consider price to be in balance. And as I explained a couple of weeks ago, it's in ranges like this, of course, that the majority of volume is traded, because that's where the liquidity is. That's where large traders are doing business. And you can see, obviously, that's where the majority of volume is going to be traded. And as a result of long memory and order flow, okay, if you think back to the webinar on scale a few weeks ago, previously executed volume, as kind of recorded on the volume profile, previously executed volume is, it's a relatively good kind of proxy or yardstick for liquidity. Okay, and many of the institutional execution algorithms trade using volume profile, mainly using VWAP, which is the volume weighted average price, as a kind of a measure, basically to execute the majority of large orders when the market is most liquid. And so it's in these high volume areas, okay, in areas like this and areas like this, that we can expect liquidity to be pooling, because that's where large or influential participants are getting in and out of positions. And as I've explained, volatility is a function of liquidity. So if traders are willing to provide liquidity, price will get kind of stuck. Okay. So you might think of liquidity as a kind of a friction, and conversely, if there's no liquidity, like in here, okay, see no volume is traded there, then price is going to run through that area relatively quickly, as it does here, especially if there's some market structure which is going to act as a trigger for an increase in order flow as price is moving into these areas. In this case, these highs. Okay. So the general rule of thumb when looking at volume profile is that price tends to accelerate through or away from areas of low volume, and I'll get onto that in a minute, and slow down or get kind of stuck at areas of high volume. Anyone got any questions about that so far? Apologies if this is quite basic to some of you, but I thought we'd just best start at the beginning. Okay, I'll just get on with it then. So, of course, it's as price is consolidating that areas of high volume start to build, and you might have heard these areas described as high volume nodes, or HVNs, which is just like this one here, okay, which is just a build up of volume at a specific price, or a very small range of prices. That's why you call it a high volume node. A high volume area, HVA, is the same thing, build up of volume, but over a wider ranges of prices. So this would be described as an HVA, or a high volume area. And it's the edges of these high volume areas where the volume begins to kind of drop off dramatically, These are, of course, what people refer to as support and resistance. So all support and resistance, or what people call support and resistance, can be directly tied to volume profile. If a level's there, it's on the profile. So if a support or resistance level is forming, that level will always be reflected in the profile as a kind of a ledge or low volume node. Okay, like this one at 6,800. So the profile, or a composite profile like this, is a really good tool for kind of objectively finding and marking out levels without having to think too much. So let's see, just for example, if I just go ahead and mark out all of these kind of low volume nodes here, something like that. There's one there, one up there, one up here. So, that only takes a second, and you can see how kind of nice or clean the interaction is around these levels. They appear to have some significance, and they're really not random. And I'll explain why later on. Another question you might have is, where do you? Yeah, exactly, Alex. That's hindsight because the volume profile changes to fit current data. But what you'll find is that these levels will shift depending on how much of the chart you choose to include in this kind of snapshot, or as price evolves, but not as much as you might expect. The reason being that order flow is persistent. Okay, it has a long memory, so those areas which have rejected price in the past tend to remain as low volume areas over time, and the same with high volume areas. Okay, because there's liquidity at high volume areas, price tends to spend more time kind of rotating around those areas in the future, so building more volume there. And so what you'll find is that if I were to mark out all of the high volume areas and all of the low volume nodes here, if I just kind of let this play out, you'll see that they tend to remain relatively kind of consistent over time. Okay. For example, this LVN at 7.7 and the one at 7.2, just keep your eye on those. Okay, you see that more volumes building, but those levels tend to kind of remain over time, right? Yeah, exactly, Alex. So as a result of the long memory and order flow, volume tends to build at previous high volume areas, and levels at which price spent little trading in the past tend to kind of remain low in volume as a general rule. Obviously they'll shift a bit and move around as price evolves, but the point is that you really don't need to be too picky about what you do in this kind of snapshot when you're marking out these levels. So yeah, if an apparent support resistance level is forming, that level will always be reflected in the profile as a ledge or a low volume node. So here, for example, okay, you can quite clearly see where price found resistance. I mean, you can see it on a candlestick chart, but volume profile is a nice tool to kind of mark this out objectively if you want to make things simple for yourself. So you can see where price found resistance in that range because relatively little volume traded there. Every time price moved up to that level, it got rejected. And so when a price is in a range like this, what I'd be doing is marking that out and then honing into this area here. Okay, looking in there on the lower time frames to find the pocket of liquidity which is kind of containing or holding price down there. So that would be your flag limit, whatever structure is in there on the lower time frames and it's sitting on that low volume node holding price down. Here, for example, okay, there's the low volume node. That's the flag limit which is constraining this flag. And as I say, usually you can see this on a candlestick chart, but for some of you might prefer this way of visualizing price and volume data. And of course, when price is in a range, it will typically bounce off or reject these levels, these LVNs, and move back into what market profile now is called value. Value being the area in the middle of the range, the area in which large amounts of volume are being transacted. So the meat of the range in here. Okay. So I'm at a point now where I can quite quickly adapt to different market conditions, but because it's easy to get chopped up when price is going through long periods of consolidation. Using something like volume profile to help you filter trades can be really useful, because liquidity equals friction. We rarely get the volatility we want as a trader when price is in the middle of a range. Okay, so areas of high volume therefore represent unfavorable trading conditions for the most part for trading on the lower time frames. So when you get a day which resembles like a normal distribution, okay, a D-shaped day, one thing you can do is pull up a daily profile, okay, market profile, volume profile. It doesn't really matter too much. Just to remind yourself that you should be looking for opportunities both at the edges, at the extremes, okay, outside of value, and on a breakout, okay, but not in the middle. Okay, so here, the way I've got this marked out is the kind of value area is highlighted in white here, and on the volume profile in, I think that's grey there. I'm colorblind, so I'm not quite sure, but that's the value area. That's where 70% of the time price traded, or where 70% of the volume was transacted for that day. And so having these levels marked out can be a good kind of visual reminder that really you don't want to be trading in this high volume area. Opportunities present themselves outside of value. Okay, so either you want to be trading outside of value, looking for, I guess, kind of a reversion to the mean, right, for price to move back into the value area, or you're watching for price to kind of break out from these areas of consolidation. And as I say, this is nothing really you can't get from the candlestick chart, and you may already be quite good at recognizing where and when you should be looking for trades, but yeah, for some, I think this is a nice kind of visual reminder. And if you're of a more kind of mechanical mind, it can really help keep things consistent for those of you who prefer, perhaps a more kind of mechanical way of filtering trades. So as I say, this is where the idea of value comes into play, where 70% of the volume is traded, and where the conditions for trading are often undesirable. So not a bad metric for determining when to be on the lookout for opportunities and when to stay out and wait on the sidelines. Because as I say, you don't want to be trading in the middle there. It's a swimming pool of volume, kind of ripe for chop and misdirection. So when the market's in a range, you want to be looking for opportunities outside of value. If price moves out of equilibrium, out of that value area on low volume, for example, when it's ranging, it's quite likely that price will move back into value. It will revert to the mean. And so generally speaking, when price is in a range like it is here, okay, over a period of 6 or 7 days, we want to be trading or taking entries around where volume starts to taper off. If you were to look at a composite chart, these would be your low volume nodes, okay? And on the daily market profile or volume profile, those areas where really very little volume is being traded. In other words, you're taking entries on interaction with the extremes, anticipating a move back into value, back into the HVA. And there are, of course, a number of different ways you can trade this. What I'm usually looking for is, as always, some fresh or untested liquidity, price action on the lower time frames, okay, or a false break setup, which I'll come on to next week. But just to demonstrate the kind of principle here, I'll just run through what tends to happen, so you have a good idea of how kind of consistent this behavior is. And the idea is just that when price moves out of value and then trades back into the previous day's value area, one kind of mechanical trade strategy which you can explore is to trade it back to the other side of the previous day's value area with something like a stop beyond the previous day's high or low. So if I just split this up, for example, and I mark out the previous day's value area high, okay, the idea here is that when price moves out of the previous day's value area, okay, and then comes back into it here, you can short it with a stop above the previous day's high, targeting the other side of the previous day's value area low. Okay. And the next day, as the value area low, okay, price moves out of value, comes back into value. If you were to long that with a stop below the previous day's low, targeting the previous day's value area high, there's a nice trade there, but it's so consistent. And as I say, I don't trade this myself. This is just kind of to demonstrate, what tends to happen when price is ranging. Okay, the next day, price moves out of value. Okay, in the first hour, comes back into value, stop above the previous day's high, targeting the previous day's value area low. And let's see, the same thing again. Okay, out of value, back in, stop above the previous day's high. There's the value area low. So this works really well in ranging markets. And of course, a strategy like this isn't a magic bullet. I'm really just showing you this to emphasize the principle that if the market's ranging, you should be looking to fade the extremes. Okay, looking to run price back down into where the bulk of volume is trading. And there's real value in thinking like this, because it's well known that price spends more time kind of ranging than it does violently trending. But at some point, of course, price will break out in search of liquidity. At some point, the state of liquidity will change and price will break out of this range. So either buyers will overwhelm sellers or vice versa, either because liquidity just dries up or as a result of large or aggressive buying or selling, or both. And we don't know when price will break out, but one thing to watch for, as well as consumption of liquidity on a candlestick chart, for example, is for the point of control. The point of control being, that's just a term for the price or the series of prices at which the most volume is transacted or was transacted. Okay, that's the point of control. So here I've got it highlighted in orange on the profile and in this kind of cream or light grey on the volume profile. Okay, point at which most volume was transacted. And so one thing to look for when you're anticipating a breakout is for the point of control or POC to start moving away from or outside of value. So here, for example, over a series of 5 or 6 days, all of the volume was traded in this kind of general area. On the 6th day, the point of control down here migrated outside of value. Okay, price is kind of quote unquote finding acceptance outside of value, down in these dark gray areas, okay, which were previously outside of value. And similar here, you get a range for 3 or 4 days. Halfway through this 4th day here, price starts building volume outside of value. Okay, the previous 3 days, really very little volume was transacted here, and on the 4th day, volume starts to build down at the lows. And if price is to remain in balance, I really don't expect sellers to be providing liquidity down in here, because these are relatively inadvantageous prices. The fact that volume is starting to build at the lower end of the range suggests that a breakout is imminent. Okay, an area we expect to reject price is failing to reject, and that tells us that likely either market buyers are weak or sellers are becoming more aggressive. Okay, they're willing to absorb or get filled at lower and lower prices. And so if I see this, the point of control or POC migrating outside of value, I'm usually kind of on the lookout for a breakout. Okay, that's not a bad example. That's value. Okay, doesn't need to be too precise. You can clearly see that's where the majority of volume was traded over a period of 4 days, and then on the 5th day, halfway through the day, volume starts to build up in these low volume areas. Okay, so areas which we expect to reject price aren't rejecting price. That tells us that buyers are willing to absorb sellers at higher prices. Okay, so while price trades up here, that both represents the consumption of whatever sell side liquidity was holding this range down. Okay, because price is trading there, sell limits are getting consumed. It also tells us that there's likely buy limits are willing to move up with price. They're willing to absorb sellers at higher and higher prices. Okay, so that's when you should be on the lookout for a breakout. And when price does break out, this is what you get. Okay, imbalance. So a low volume area, often referred to as single prints or singles, which just refer to the fact that price will only trade there one time. So a fast illiquid move in which what you'll get is traders kind of caught on the wrong end of the breakout. They'll be getting stopped out or unwinding, and the market has to start reaching to find liquidity. And all that's going on here is that nobody is providing liquidity there, and so price will generally move until it hits some more significant volume. So at some point, buyers or sellers will dry up. Okay, in this case, buyers will dry up, or price will hit a pocket of liquidity and stall. Okay, hit some liquidity and stall, and price will pause and range for a brief time before either reversing or moving on up or down. Okay, so this is when you'll often get a P or B shaped profile. In this case, that's your P shaped profile. So a distribution characterized by a long, thin, by which I mean low volume move. Okay, at the beginning of the day, and a more well developed or balanced profile at the top or bottom. Now, whether or not you want to be fading a move like this totally depends on context. But the general rule of thumb is that if price has just broken out from an extended period of consolidation, which will of course appear on the volume profile as a high volume area or HVA, then you should be looking to trade with the flow. So if we just find an example here. Okay, that's a nice example. Okay, so high volume area, price spends an extended amount of time trading there. After a sharp move higher, like this one here, you want to be looking for and taking trades at a volume shelf, so the bottom ledge of an HVN, okay, down in here. That's essentially your flag limit. You want to be taking trades off that, looking to trade with the flow, okay, with the breakout, because that's your last point of reference. That's where the liquidity is. And if price starts trading into that low volume area, we know that it's very likely to slip back down through there and fill in the profile because there's just no liquidity there. So that volume shelf there is your kind of invalidation for longs. And sometimes, of course, that spike is just the result of shorts covering, not indicative of any real buying interest. And so there's unlikely to be any real follow through. And so what will happen is the market will stall, and once the participants who are short have covered their positions, and if the higher time frame flows are still down, as I say, price will simply draw back into this low volume area and carry on down. Another quite nice example here. So price spends an extended amount of time consolidating down at 3-4K. Price breaks out. Our expectation is that this is going to continue, okay, because it's just broken out of an extended consolidation at a high volume area. What you want to be doing is identifying these flag limits. The low volume node here, that short invalidation, you want to be taking trades as low as possible in this flag limit, looking for continuation to trade with the flow. And if for some reason you're wrong on this, a break back down below this presents a really nice opportunity to get in short, targeting either the singles, okay, the start of the singles down here, the start of that low volume move, or you know, just a more high volume area, a more significant HVA. So that's how I view volume profile and how you can use it to kind of gauge the market environment. But of course, most of that can kind of be derived from a candlestick chart if your eyes are trained to spot this stuff. It's just about using what makes sense to you. And for some of you, volume profile might just click or bring a little more clarity to your trading. That being said, the profile can also help you locate levels which aren't really readily apparent on the candlestick chart. So, for example, because volatility is a function of liquidity, as I've explained, high volume nodes or points of control can make for really good targets. So sometimes the market will appear to stop in the middle of nowhere, and often what you'll find is that if you pull up a profile, there'll be a high volume node sitting there. So, for example, let's take this run up in 2017. So if I just mark out all of the high volume nodes on this run up, there's one kind of there, okay, there, one in there, in there, in here, down in here. And we just play price. You'll see that, especially when price runs into these levels kind of thin, they'll tend to deflect price. Okay, so you might not have a level there, but if you pull up a profile, you can find some really kind of good levels, right? So high volume nodes can deflect price, especially, as always, if price runs thin into the level, which is why it's a good idea to take profits at high volume areas. And this is particularly true when trading, I guess, kind of counter trend in trending environments. So let's say you've got something like this, okay, a clear trend. Obviously, the high volume areas, the areas at which price spends more time consolidating. If you're trading counter trend in this environment, let's say you've got some liquidity up here, and you're trading it down into this last FTR, you don't want to be holding that short past that HVN or that high volume area, because, as I've explained, we expect these areas to hold because that's where liquidity is, and for price to carry on up. And so when price pulls back to an HVA, when price is trending and you're trading counter trend, take your profits, because as a result of the fact that we've got resting orders there, right, liquidity tends to accumulate at high volume areas, whether that's long-term participants getting in or traders stuck on the wrong side of the market getting out. The POC in particular will often generate a response. And even if price does end up engulfing that high volume area, more often than not, it's at least going to slow down and kind of chop around in there before it starts breaking down. So it will build volume at areas where volume built in the past. And for me, that's not the kind of price action I like, because it's mentally exhausting. So if you're trading counter trending environment, it's a good idea to take profit at high volume areas. So yeah, those HVAs and the POC in particular have a kind of a memory and a strong reference points in trending markets. They're really good kind of structural components to look at for bias. That being said, it's important to stress that you shouldn't expect the market to stop precisely at high volume nodes. Okay, they have a kind of attractive quality, and that price seeks liquidity. Okay, and they make good targets, and those areas will tend to slow price down because that's where liquidity is. And sometimes price will bounce there, especially if the market's moving quickly. But yeah, high volume areas, high volume nodes, they are, in my experience, nowhere near as kind of precise as low volume nodes, of which you can sometimes get really aggressive entries. And I'll just use an example I used in the last mentorship to demonstrate, because it's quite a nice one. Okay, so I've just got this run up here back at the top, and what I'll do is just cover this whole move, marking out both HVNs and LVNs, just to demonstrate how price tends to interact around these levels. Okay, so I'll mark out the LVNs in grey here. Okay, something like that. And the HVNs in red. And then we'll just watch how price interacts around those levels as price kind of breaks back down through this area. So price consolidates up here, suggestive of kind of topping action, because price is more volatile, which represents an absence of liquidity. Okay, tight ranges on the way up suggests that bidders are strong. Okay, when price starts to get a little more wild, like it does up here, that's often a good time to start kind of expecting a top, because it's indicative of an absence of liquidity. Okay, the ranges are getting wider. Anyway, price consolidates up there. Breaks back down through this LVN quite easily, which is not unsurprising given that it's just broken out of this 3 or 4 day range. And as I've explained, I think in previous webinars, I'm not generally looking to buy price support levels. Okay, so this LVN represents this one here, formed on the way up. I'm not looking to buy those levels which were formed on the way up if the market's now trending down. Why? Because price is now seeking buyers, and the liquidity here, whatever was supporting this structure here, and which kind of created this low volume node, right, which separated these two ranges. Okay, so there was some buy side liquidity in here, which held price up here, causing a volume cluster to appear here, which is separate from that one here. Okay, that's why the LVN forms. So that's what you consider the kind of broad support level. I'm not looking to buy that support level when price is now trending down, because the liquidity there is already likely quite weak, because it was prices traded there on the way up. Okay. So if price is moving up, the LVNs are what I look at to, this one here, that's what you're looking to buy. But when the market returns to that LVN on the way down, I don't really expect it to hold. Okay. Price is trending down. You expect those levels to fail and for price to carry on down. Anyway, you'll see that what generally happens is that price will stop or slow down and kind of chop around at previous HVNs as it consumes the remaining liquidity there, and then it will flip the low volume nodes. So those low volume nodes, once they get broken, that's one area I'm looking at for FTRs when price is trending like this. Okay, so price breaks through the LVN in grey here. Okay, some structure forms there. It chops around the HVN in red as it consumes the remaining liquidity at that level. A level like this sitting on that LVN is a great level to look at for continuation. Okay, so again, price breaks down through the next LVN, forms some structure there, chops around the high volume node, okay, consolidates there, and then continues down off the FTR which formed at the low volume node. And again, breaks this LVN quite easily. There's not much liquidity there. Stalls at the higher volume node here. Breaks down off that FTR, and then just drops quite quickly to this HVN down here. And that's when you get the reversal. And it's not surprising given the nature of this move into the level and the volume build here, which is usually indicative of some more significant liquidity. So this is generally what I'm looking for when I'm tracking price in relation to the profile, for price to stall at these more voluminous areas and then flip those low volume nodes which were created or kind of formed when price was trending in the opposite direction. Okay, in this case, prior support levels, okay, areas in which price found support. And back to your question, Alex, you can see if I let this kind of play out, that these levels will probably remain kind of relevant over time. Okay. And as I say, this is what's called a composite chart. Traditional market profile charts are made up of a day's worth of data, but oftentimes like this, you want to look at how volume has been distributed over a much longer time interval. And this is where composite profiles are really useful, especially for those of you who have trouble getting your head around scale. Because with a composite profile, you can get a really good overview of the high time frame market structure, but without having to think too much or worry about time frame. Because of course, here, for example, even if I were to change the time frame here, the shape or the distribution of the profile will stay the same. So no matter what time frame you're on, it's quite clear here where large amounts of volume have been transacted, right? And conversely, where very little volume has been transacted. And so for some of you, the real value in the profile, I think, or specifically in the composite profile like this, will be in getting your head around scale. So here, for example, price moves from balance, high volume to imbalance, balance, high volume to imbalance, okay? And this dynamic plays out on all time frames. So whatever the time frame, if price is in a bracket or, a roughly D-shaped distribution, a range, okay, then as I explained when we went over market profile briefly, you should either be fading the extremes, looking for mean reversion, for a move back into value, back into where the majority of volume is being traded, or waiting for a breakout into a low volume area like this here. And looking for continuation trades, looking to run price up into the next high volume area up here. And you will have noticed by now that large clusters of volume precede big moves, okay? And so it's generally the case that the larger the balance, the larger the imbalance, and you can therefore expect significant follow through when price breaks out of a range or consolidation like this one here. Especially if the breakout is into or through an area where little volume is traded in the past. And so when price breaks out of an HVA and into a low volume area, a thin or illiquid move like this one here, you should always be looking to take trades with the short-term trend, okay? You should expect continuation until price starts bumping up against a more voluminous area. So an area of volume comparable to this one here, in this case up here. And so what you can do is take trades on the lower time frames up in here, for example, at this flag limit, looking for continuation, okay, trying to run them up on the higher time frames. So trying to run them up to a similarly large volume build. Does that make sense? So, you know, it doesn't matter what time frame you're on, the levels are clear here, okay? Price has broken out of this high volume area. You can expect it to go to an area of similar volume up in here at 6.4. So I find using the profile can take some of the confusion out of charting, particularly when it comes to time frame or scale, because it's a great way of identifying where you can expect the liquidity dynamics to shift, but also of forming some kind of expectation for price. Okay, price has broken out this high volume area. There's no volume here. Our expectation is that price will continue until it hits a similarly kind of voluminous area. Okay, and that gives you the trade here. That's the bias. So yeah, that's it. I mean, we've just kind of scratched the surface here. It's been a bit of a crash course on the profile, but if you want to talk more about this, then as I say, you're welcome to get in touch and we can meet up to go over it one-on-one. But yeah, that's all for today. I hope it's been useful for you.